closing transfers. From the accounting cycle, you'll remember that we start off by recording a transaction on a source document. So you'll have a slip or something with the date, etc., and you'll record that source document. The first place that you record that in the accounting cycle is the journals. So you've typically got your CPJ or your CRJ. So then you've got your journals, which is a diary of your transactions. There's a list of transactions, and you record the transaction in the different columns depending on what the transaction was. After you've recorded all the transactions in the journals, so there's my transaction TX for transaction, you then post these totals in the journals and these individual amounts in the sundry column. You post that to the general ledger. The general ledger is your T accounts that records all the transactions of the entity. So you've got all your debits and credits on the various T accounts in the general ledger. Now, this is a very large number of transactions, so this is then summarized in what is known as a pre-adjustment trial balance, which is simply a list of all of these accounts and their balances. Pre-adjustment trial balance. So we've got our debits and our credits, and then we've got a list of all of these accounts that we had here in this pre-adjustment trial balance with only a single amount for each of them. Alright, so that's my pre-adjustment trial balance. It's pre-adjustments because we have not yet done any adjustments. It does not yet represent the true picture of what actually happened during the year. So then, at the year end, we need to do some adjustments. Alright, so we're going to record our adjustments typically in the general journal. So the general journal is a simple debit and credit. So you debit an account and you credit an account, and you need to record the amount as well. Once you've recorded the debit and credit in the general journal, you need to remember to post that to the general ledger again. So we'll post that to our ledger, something like that. Then we've recorded our adjustments. Right, now we're ready to prepare a new list. Alright, so this was our first list, pre-adjustment. Now we've made our adjustments, and now these balances now reflect the true picture, and this new list is what is known as a post-adjustment trial balance. Also got your debits and credits, all the amounts, but now these balances and totals have been updated and they do reflect the true picture. Right, so this one here is the true picture, as you should remember from the adjustments. And this is where we are now. We've got our new list, the post-adjustment trial balance, and this is where my closing transfers are going to come in. And with the closing transfers, we're going to close off everything in the nominal account section in the post-adjustment trial balance, and we're going to close it off to the retained income account, and you'll see how we do that just now. So our closing transfers are going to take place at the end of the year, just after our adjustments. So at the year end, and similar to our adjustments, we're going to start off with a trial balance, which is known as, in this case, our post-adjustment trial balance. Then we're going to prepare our general journal, same as adjustments. We first recorded our adjustments in the journal. Then we're going to post that adjustment, and in this case the closing transfer, to the general ledger, and then after that we'll be able to come up with a new trial balance known as the post-closing trial balance. Now, just quickly conceptually, what is closing transfers? And this is often referred to as the missing link. The missing link between what, you may ask, and it is the missing link between the income statement and the balance sheet. So let's have a look at an example just to just to illustrate that. Let's assume we have a student, and let's call him Tabo, and he is a very entrepreneurial student. So he doesn't just go to school to learn things, he goes to school to make money. So when he wakes up in the morning, the first thing he does is he looks at his wallet, and he finds that there is 100 Rand inside his wallet. Now he's not happy with that, so during the day he buys and sells a whole lot of things, and he makes 10 Rand here, 5 Rand here, another 5 Rand here, and just before the close of the day he makes another 5 Rand. At the end of the day then, he takes all of this money that he made and he puts it back into his wallet. So he started off with 100 Rand. There was his 100 Rand. And then he takes all of this money that he made during the day and he puts it into his wallet. But he puts it in a very specific place inside his wallet. So let's quickly draw that. There is the very specific place where he's going to be placing this 10 Rand, the 5 Rand, another 5 Rand, and the final 5 Rand. So to summarize then, he started with 100 Rand, he made 25 Rand during his day. Okay, so this was one day, right? And finally he's got 125 Rand at the end of his day. Now how on earth does this relate to closing transfers? Well, in accounting, the process of taking this 25 Rand and putting it into the wallet is known as the closing transfers. So this right here is what is going to be known as the closing transfers. And this 25 Rand in accounting is what is known as my income statement. The 125 Rand in accounting right here is what is known as my balance sheet. So you can almost say that the Tabo's wallet represents the balance sheet. The very specific place inside the wallet, inside the balance sheet, that Tabo takes this amount from the income statement is going to be called the retained income. Okay, so that's the very specific place in the balance sheet that Tabo is going to put this money. So our closing transfers is going to take my incomes and expenses, right? Inside the income statement is incomes and expenses, and we're going to take that and we're going to place it in a very specific place in the balance sheet known as retained income. And that is what my closing transfers aim to do. Just quickly, some more accounting terminology that is sometimes used. The income statement is also known as the statement of comprehensive income. And the income statement shows me the financial performance of an entity. The balance sheet is also known as the statement of financial position, and that is going to show me the financial position of an entity at a specific point in time. You will see that the wallet is updated at a specific point in time, so we can say that the balance sheet is a snapshot at a point in time. At a point in time. And we can say that the income statement is the movement during a period. Now in the example that we used, Tabo, we had a period of 1 day. Typically in accounting we'll have a period of 1 year, and that is going to be known as my financial year. So to summarize then, closing transfers is a process of taking all the incomes and expenses that I earned during the financial year and putting them in a very specific place inside the balance sheet known as my retained income.